Hello. In today's video, I will just show you two charts. The first one will be that of the euro dollar. So we will see that there was a very important technical event this week. Then I will show you another chart, which is the chart of the Euro Stoxx 50. So first chart, euro dollar. So as a reminder, the euro dollar validated a head and shoulder pattern. So you can see it here. Sorry, it's not it's not a beautiful picture, but I mean the idea is that we had a breakdown, technical breakdown below the neckline of this head and shoulder. So it was in late October. Then there was some whipsaws below the neckline. And suddenly, so at the start of this week, a strong recovery back above the neckline. So from a technical point of view, this is the message from the market is very clear. The market rejected the bear case, which was the head and shoulder case, and is moving back inside its trading range. So which, from a technical perspective, from an Elliott wave point of view, suggests that we made a wave 4 over the last 2 months, which is, I mean, a wave 4 is a typical correction within an uptrend. So here you have a wave 1, a wave 2, a wave 3, a wave 4. Possibly this wave 4 may have ended in November. There is an alternative case which would be to build a kind of triangle pattern within coming months, in which case the wave 4 is not over and we'll have to go further with whipsaws until the end of the year. But in any case, I mean, we should retest, according to this scenario, 121 and even go higher. So as most of you probably know, in wave after wave 4, you have a wave 5 to the upside. So which means new highs above 121. So from a technical point of view, the no more bear case prevailing on the euro dollar, and possibly back to new highs by the start of next year. So a pretty big change in the technical scenario. Now I will focus on Euro Stoxx 50. We saw a big move this week on Euro Stoxx 50. So this is a volatility, strong volatility pickup. As you see, we haven't seen such a strong decline so far this year. So the correction we noticed between May and August was a slow slide, and this one is pretty sharp. So big change in terms of short-term trend on the market. I don't think it's I think it's too early to call for the start of a big downside move. My interpretation of this move is that it's more a mean reversal within an uptrend. This rise, this upside move we saw in late October was probably too far too fast. Then we have obviously a mean reversal now towards the 200-day moving average. So as you can see, the 200-day moving average has been a strong support in the past. So especially in September, and also in late at the end of last year. So what we are starting to see right now, a technical bounce above the 200-day moving average is a typical short-term buying opportunity. I don't consider it as a major buying opportunity. I think we are likely to see a technical bounce, possibly a bit higher, possibly to 3,600 or a bit more, probably not back to 3,700. Why? Because I mean, if you look at the 14-day RSI, it was massively overbought at the start of the correction, so very strong overbought situation. It turned oversold 2 days ago, so on Wednesday. And I think what we are likely to see is a technical bounce from oversold condition, probably not the start of a big upside move. then the market will probably become a bit more volatile and hit a low, let's say in a week or two, and possibly going back up again, because as we know, the end of the year, especially in a bullish year, is not, I mean, we shouldn't expect a major fall of European markets by the end of the year. I don't think it's likely. What is likely is to see further dips than a recovery towards the end of the year. Thank you. It's all for today.